The views expressed in the following show are of the host, the guest, and the callers. The content of the following show, its accuracy, authenticity, and the ramifications of the use or application of said content is the responsibility of those speaking and listening, not the broadcast medium. All right, we are going to bring on Lional Parkinson. Now, for those who've been listening to Feet to Fire for a long time, he's kind of a dual guy on the show. His official book that he's put out, which is The Holy Virus, excellent reading for those who are into the Old and New Testaments and, for that matter, the Torah, and want to find out some interesting information about how it has been corrupt back in the Babylon days and so on. So that's not what we're talking about today. I just want to throw it out there, holyvirus.com. But we've had him on several times now, and he has been an advocate for how to deal with the coming collapse. And one of the shows we've did before was how gold isn't as safe as one might think. That is up on Facebook. On YouTube, and also on Conspiracy Channel. And did another show about the coming negative interest rates, which will impact, of course, your savings, where you'll end up paying money to have your money in savings. And he went through what you can do as an alternative. He was investigating. I want to say that Lionel is coming to this with these information without any axe to grind. Doesn't have a book. Doesn't have a fund or something. He's trying to get people to join. He is just basically a concerned citizen, if you will, just a person who is sharing his information and warning people what he sees coming and why and what he can do about it. And what we've done today is we're going to put together an interview to actually talk about US Treasury Securities as a potential place to put your money in a coming crash. Now, before everybody goes wild here with gold and, crashes and Federal Reserves and all this stuff, you have to listen, because Lionel really gave me some schooling as I was driving around asking him questions about this, on how things work, that the U.S. Treasuries are actually like outside of the banking system, and that we need to know certain things about the banking system and how unsafe it is and whatnot. And for that matter, how gold, in a pinch, will collapse as well. So we're going to get into these things about what to do if gold isn't an option, and you've already got cash hanging around, which is our last couple shows, showing why that's important to have cash. We're going to get into the U.S. Treasury Securities around that area and what information he's put together. Lional Parkinson is a document verifier by trade. Among other things, is a jack of all trade out in Idaho. And he is not related to Chuck Norris because he gets that quite often. You can see the picture up on the screen. He has done this work is important because it's done as a outsider, let's say, a personal interest, as opposed to professional trying to get you to invest. So that's why I like to have him back on here. And then we hit the magic button and welcome back, Lional Parkinson. Welcome to the show, Lionel.
Hey, it's great. I'm really excited about this program, and I'm really happy that you're going to give me the chance to at least give out some information and some historical data that I help people understand what is really going on and how to thwart the upcoming confiscations that are going to happen in the banks. And I just thank you personally for this opportunity.
Well, I thank you for sharing. I mean, you could just sit in your abode with this information and apply it to your own personal self, and that would be fine. Maybe some friends and family, but you're taking the time to put this out worldwide to help those who may. And again, I ought to stress this: you have no axe to grind, meaning that if people listen to you or don't, there's nothing to sell, buy, or otherwise. And so that's why I appreciate your desire just to help out people.
Yeah, again, I appreciate that very much because a lot of bad information is out there right now, and it's going to get a lot of people in a position that they could lose everything they've worked for, or at least a good portion of it. And I'm trying to do this program with you to help give people another option, at least a little bit more information before they make incorrect decisions in their life. So, yeah, I'm ready to get started on this. So,
all right, well, take us on the journey. We have some documents that you've put together just as a quick kind of outline and definitions and all that. They will be downloadable if you look into the information underneath this video. You will find, or on our website for this show, the audio portion will be broadcast Sunday, October 30th, and we will put that information in the audio archive as well. You could download these things in a PDF format. We have that information. I'll be referring to it as we go. So take us away on your journey to help us understand these things and what we can do.
All right. Yeah, first off, this whole financial world is like a maze. It's gotten extremely complicating, as you well know. Without giving a complete history on it and how it began and everything, I'd like to just start off. Since we're doing this program on October 30th, 2016, the day before Halloween, we're seeing in the news that right before an election, for instance, Wells Fargo, there is a serious run on the banks due to their indiscretions with people's accounts. And I've done a little bit of history on them and their derivative exposures, and now that the people are really mad and they're starting to pull their money out, that they are estimated to lose $8 billion in revenues and even up to $200 billion in deposits. This will force them to do massive cutbacks, layoffs, and we also are seeing in the news that a potential or highly potential war could break out between the United States and Russia. I believe there's a reason why there's a connection between the banks over in Germany that are blowing up, like Deutsche Bank and Commercial Bank. They're not just laying off thousands, but tens of thousands of people to cover the losses that they're experiencing, and why the Deutsche Bank in Germany can't even pay a $14 billion fine that the Department of Justice is trying to lay on them. The banks around the world are actually broke, but the banks here, after the financial collapse that we experienced in 2008, 2009, they were given a taxpayer bailout, but it was not good enough. And what happened is that the billions, the hundreds of billions of dollars that they were given through a taxpayer bailout, they had to come up with a legal way to confiscate people's bank accounts here in this country and around the world without announcing it. And in 2010, they came up with the Dodd-Frank Act, and this is what I focus my attention on. And the Dodd-Frank Act was called also the Wall Street Reform and Consumer Protection Act, and it took up 848 pages and contained 383,000 words. Now, in July of 2012, an additional 8,843 pages of rules were added, representing
8,000.
30% of the Yeah. Now, the estimates for the final length of the act is 30,000 pages. Now, this was put together by the 6 largest banks in the U.S., which spent $29.4 million lobbying Congress in 2010 and flooded Capitol Hill with about 3,000 lobbyists. That's about 5 lobbyists per congressman. The Dodd-Frank Wall Street Reform and Consumer Protection Act currently stands as the single longest bill ever passed by the U.S. government.
Oh gosh!
Now this is what I dug up in finding out, because nobody wants to spend time looking at this type of stuff. But as a former document examiner, and a lot of times I like to look at this, as you well know, when I wrote the book on the Holy Virus, I had to read the Bible and do some historical findings and find evidence outside the Bible to find out whether it was correct. But this particular document is far more complicated than the Bible that I wrote a book on. So
it's more complicated than the Bible. That's funny.
Yeah. It really. But what it does, the bank bailouts of 2008 and 2009 will now be the history of Dodd-Frank, because now it authorizes the FDIC, which is the Federal Deposit Insurance Corporation, to recapitalize failed financial institutions by confiscating customers' deposits. The FDIC was originally created to protect the depositor when the bank went down. Now, it's just the opposite. It is going to be used and is specifically designed to insure the banks now, because bail-in actually occurred when they put this act into effect in 2010, and they modified it in 2012. As you remember, we did a program that I back in 2012 on the prediction, on my prediction on gold and silver, when gold was up around 1900 and silver was at around 42. I told you then that it would collapse, and it did. I also made the prediction that we could see a massive collapse in the stock market. What entailed soon after, there was no collapse in the stock market, and this is the reason why. The Dodd-Frank Act prevented banks from ever declaring that they're bankrupt, because if they did that, the game would be over. What they did, this act allows them to confiscate people's bank accounts, changing their status from a depositor to an unsecured creditor without them even announcing that they went bankrupt. So not only did they get the taxpayer bailouts of 2008 and 2009, but they got the bail-in that these 6 largest banks wanted through the Dodd-Frank Act of 2010 and 2012.
I think we've got to stop there for a second and let that sink in, is that before this act, you used to put your money in the bank, and the bank owed you, and you owned the money, I should say, and they owed you. Now, under this act, when you put the money in the bank, they own the money, meaning that they control whatever happens to it, and you're an unsecured creditor, which means that if the bank fails, they do not have to pay you.
Correct. You are the last on the line of, legal, I guess you'd call people that get paid in a financial. But the Dodd-Frank Act allows the gambling institutions that these banks are now, because they're not really loaning institutions, but they are gambling with people's deposits and trying to make money in the casino of Wall Street through bets on commodities, stocks, and some, I admit, will even use bonds. They do make some investments in safe securities, but by and large, your Wells Fargo recently had to conduct very desperate acts to try and raise money, and they got caught and they got fined for it. Now customers are very mad, and they're pulling their money out of the bank, and there is a massive run. And again, this is what's taking place. We got desperate banks that got bailed out in 2008 and 2009 with taxpayer money. They got bailed in money with people's deposits in 2010 and 2012. Now, they might have just used, some of these large banks have used up all the deposit money and the taxpayer money, and now are desperate, trying to raise money any way that they can. So they're waiting around for their next bailout. And that's why we did that other program. The only way they can keep the system going is to go and hope for negative interest rates. And that's the only way they can get bailed out. But I wanted to at least touch on this Dodd-Frank Act, as the FDIC now is no longer a saving grace for the depositor. It has now been authorized legally by this act to work in reverse, kind of like a Robin Hood in reverse effect, where it steals from the poor depositor and gives to the bank. And it gives them all legal status to do so. And this is why on this program I'm suggesting to thwart the banks by pulling your money out physically in cash. Do what the customers in Wells Fargo are doing right now. Pull it out in cash, because banks do not loan cash out or money out to people. What they loan out is through their fractional reserve system, is a debt-based obligation, because they are not authorized to issue out cash in the form of a loan any more than they are authorized to issue out US Treasury Securities. Only the US Treasury Department can issue out real money under the Federal Reserve System. If you look at the typical $1, $5, $10, $20, $50, $100 bill, you'll notice on there's two, I guess you'd call it seals. One will say the Department of the Treasury. The other one says the United States Federal Reserve System. When you have cash in your pocket, you are owning the only legal recognized money in a world reserves currency around the world. When you own U.S. Treasuries, I should back up and say there is no debt attached to that cash. When it's in your possession, you are owning something that is the most valuable thing within the Federal Reserve System.
Maybe we should stop for one second and say the difference is, we use the term cash. We equate that to the Federal Reserve dollar. And when you talk about securities, they're valued in the term Federal Reserve dollar. But that's only because when you pull them out into something that you can work with, it is converted into those dollars. But it's not actually anything to do with the Federal Reserve, correct?
Yeah, the cash is still connected to the Federal Reserve System, but it's issued out by the U.S. Department of the U.S. Treasury Department, and that is backed by all the tax revenues that they take in, from the fiscal year. For instance, when you put money in the bank, it isn't backed by anything, and it's transferred into a debt obligation that somebody else owes because they got a loan from that particular bank that was created off the fractional reserve system that is completely apart from the Federal Reserve System. They gave the local bank around the corner the right to create debt-based money out of thin air to a person that wants a loan on a home, let's say for $200,000. But all they did is make a ledger book entry on their balance sheets that they passed $200,000 of debt onto that unsuspecting loanee.
Right.
Now they did not receive money. They did not receive it in the form of U.S. Treasuries. All they did is they buried themselves in debt. That's all they did. That's what really happened. Now, if they would have gotten their money, when you give your let's say, when you're earning money from your job, you are earning debt-based earnings. You're not earning real money. But you can convert it into cash by pulling it up of these banks. You can also convert it into U.S. Treasuries when you loan it to the U.S. government at, let's say, and buy U.S. bonds, notes, or just bills, notes, or bonds. The only recognized money under the Federal Reserve System is bills, notes, or bonds. Debt-based money is not recognized. It's just somebody else's obligation that has to be paid.
Right, and I think that's important to understand is in the years past, you were actually paid money, and that is something that had value in and of itself. And what we've gone to now is basically a bunch of IOUs. When you get paid from your company that you're working at, they're issuing you an IOU for your salary. You turn around and that gets put in a bank, and the bank gives you an IOU for that money. And as things mess up, you end up being the last person. You're the creditor who has lent that value into the bank, and you're on the bottom of those people who stand in line to get paid if the bank fails. But if you convert that into a treasury, it pulls it out of that system and puts it into a completely different system.
Correct.
Okay.
Yeah, the local bank around the corner can only give you from their fractional reserve banking scam a debt-based, I guess you'd call it, I just call it a debt-based obligation. And this is how they've been able to extend credit out to an economy. And it looks good for a while, but eventually everything has to get paid back that was loaned out. And when it doesn't, here comes all the losses forming on the bank's balance sheets, and then you get a collapse. And then the bank sits around and says, okay, we need somebody to bail us out, which is what happened in 2008, 2009. And it was so bad that the taxpayer bailout didn't even put a Band-Aid over it. They had to come up with this Dodd-Frank Act and literally confiscate everybody's bank account, changing their status from a depositor to an unsecured creditor. And this way they didn't have to announce a bail-in. It was done through this clever little act under the Dodd-Frank Act.
The 30,000-page bill basically was designed to take the rights of your money and give it to the bank, and now they can use that to show that they can use it along with these algorithms to come up with they actually have a value. They're not broke, but they are broke.
Yeah, the unsecured IOUs that you get from the bank are just they're fully unsecured, and the FDIC now is going to be used as a confiscating agent rather than an insurance that they once were under their banks. But when you buy U.S. Treasuries securities, they're in the form of bills, notes, and bonds. Kind of think of those as nothing more than higher level currency cash. Kind of think of in cash we go up to about $100 bill and then they cut off. But in U.S. Treasuries, you can buy them in $1,000 increments. You can buy them in $5,000, $10,000 bills, and have them under your name. And get this is the main difference between you being the owner of the U.S. Treasury Security. You are the banker because you're taking your debt-based obligations, loaning those to the U.S. government, and they're giving you a U.S. security in the form of a bill, note, or bond. depending on which one you want. And they're about the same thing. The only difference is maturity dates. But theirs is backed and secured by all the taxes that they get from the Internal Revenue Service. That's why you look at the whenever you write your check out and pay your taxes, you have to write it out to the US Treasury Department. It goes to back up all those that buy US Treasuries. When you see China or Japan, which both countries own well over $1 trillion of US Treasuries, they don't go and buy or deposit their money in Wells Fargo or Citibank or JP Morgan because they know it's unsecured. They buy U.S. securities knowing that it's backed by all the full faith and credit of the U.S. government, which is really backed by all the hardworking citizens of America.
Now, that's to be contrasted. That's to be contrasted by the bank, which is backed by
nothing.
I mean, it's they'll say FDIC assured, and perhaps the FDIC will pay something, but the FDIC is not a bottomless pit. Well,
like I said, the Dodd-Frank Act already transforms the FDIC into a confiscation agent. Now,
okay.
It's no longer an insurance. So there is no underlying insurance for people to deposit their money in the bank anymore. They are completely stripped of ownership of that deposit. They are stripped of all insurance under that deposit. All you've got is you better hope that bank doesn't go under, because you will lose it. And this act guarantees that they will lose it. No insurance. There is nothing backing it now.
I would imagine that you're not the only person to figure this out, and that there are large swaths of the world value currency in treasuries.
Yeah, and this is the reason why your Mitt Romneys, your Obamas, and they all get offshore accounts out of this country, but I guarantee you that all their money is in U.S. securities in those offshore accounts, because it's still the safest place to park your money that is not caught up in this derivative leveraged casino that the regular banks are gambling with people's deposits. And this is what's been going on for decades now. They're just now getting caught when they lose. If you remember back in 1999, Bill Clinton repealed the Glass-Steagall Act, which was probably the safest thing for the depositor back there. Back then, it saved people's deposits from being gambled. Well, Clinton removed that and allowed banks to become investment institutions and gambling institutions, and they could gamble. So there was no protection there. And it literally destroyed the whole banking industry as far for the depositor. So moving now up, that created the 2008-2009 collapse, because Bill Clinton gave that repeal of the Glass-Steagall Act. And it's well known. Anybody that's in the financial world knows exactly what I'm talking about. Mm-hmm. The Glass-Steagall Act was created right after the first Great Depression in the 1930s to prevent the very thing that caused the 29 crash, which was too much leverage gambling that was created by the banks and individual investors. And back then, there was only about 5% of the people really gambling. Now you've got people in that stock market with almost everything. So it's a real, like I say, a real confusing maze now. And the whole purpose of this program is to provide a solid answer to get your money out of the debt U.S.-based obligation banks, the ones around the corner, and even the credit unions are tied to this. They have to make loans to people that are buying homes and cars that are way overpriced, probably 20, 30 times their value, burying themselves in debt, and they have to pay that back. Well, when these major banks go under, they trip the smaller banks like credit unions as well, because once you get a crash going, nobody can pay back anything, and then you got all the credit unions crashing just right along with the large banks. My advice is to get your money out of the bank in the form of cash under your own control, and that money left over you can't get out in cash. Start buying US Treasury Securities at US Treasury Direct, and you can do that through wire transfers. You can do it with checks, and this way it places your money outside the highly leveraged derivative casino that the banking system has created ever since Bill Clinton repealed the Glass-Steagall Act.
All right, so recapping, the banks are not safe because they changed the rules. They're investing the money in a casino. They're way in debt. They've made you an unsecured creditor to your own money, so that when the banks do go down, you're left with nothing. However, by putting your money into the Treasury, and I have the Treasury Direct website up on the video, that you are now transferring that money into the Treasury, which is outside the banking system, which is backed by the full faith and credit of the United States government. Now, if that government collapses, well, we're basically back to the Stone Age anyway. So, but people are going to argue, and we've talked about this before, and I don't mean to belabor your time on this, but people will argue that gold or some type of precious stuff would be a wiser investment, so that if the United States government does default on its treasuries, they will still retain some type of value. And maybe you can put 5 minutes into that so we can move on.
5 minutes, yeah.
Well, I mean, I want to get to your other stuff, which is important, but I know somebody who's listening now who they've got the banking issue. They understand how to bank while the money's not safe in the bank, but they're still holding on to precious metals. And so knowing what your personal commitment has been to divesting yourself of precious metals and actually using what you're talking about here, I just wanted to share that so then we can move on to continue.
Right. Gold and silver, by definition, is real money according to the Constitution. Unfortunately, this U.S. government does not adhere to the Constitution, because in Article 1 it states that no state shall use anything but gold and silver as legal tender in payment of any debt. So essentially your states are no longer under that Constitution. Now, the information I just gave you is very pertinent, because it's telling you that you're living in a lawless country right now that is bound by no Constitution. Right. Otherwise, every single state governor is in violation of their oath of office, because the state is supposed to be using, according to Article 1, only gold and silver as their monetary system, not a federalized system that I've been talking about. Knowing that right now tells you that you've got a big competition right now between the Federal Reserve System and why they will never allow gold and silver back in as a monetary system in the economy. They have such a stranglehold over the gold and silver system that now they've turned it into a commodity that can be traded and manipulated, just like copper can be, and or oil can be. So knowing that, one has to take a look at that and say, okay, is the Federal Reserve System really going to be destroyed? Is the U.S. government really going to be annihilated? In my opinion, that time is not coming anytime yet. Now, maybe sometime sometime in the future I can change my mind if I see certain signs that I would advocate a gold and silver investment. But right now, I'm dealing with people that need to do something with their money right now, and I feel far more confident in U.S. Treasuries than in the banks that I know that are failing and using up people's deposits as gambling tickets right now, as gambling casino chips. So I made that prediction back in 2012 on a program that nobody wanted to say that gold and silver was going to collapse on your program, and I was right. And I'm going to make that prediction one more time on this October 30th, 2016, that you're going to see a massive crash in the gold and silver market in the next stock market crash. Now, this will cause the dollar to soar, and this will force the Federal Reserve to lower interest rates in a desperate manner to try and kickstart the economy. Even though they're talking about a quarter-point rise in interest rates in December, I suspect that the stock market is going to have a severe downturn between now and the 15th of December so that they can get out of that so-called promise to raise interest rates. I think banks like Wells Fargo that is losing money hand over fist cannot afford to pay any more in interest rates to their customers. They are looking forward to negative interest rates because they can now confiscate not only their deposits, but they can also confiscate and lay a tax on people trying to save money and don't know what to do with their money. I'm trying to provide an answer right now for what people can start doing tomorrow. You can pull your money out of the bank tomorrow. You can be proactive right now and start and get the ball rolling tomorrow. Gold and silver will crash this next time worse than ever before. But that doesn't mean down the road I won't change my mind 2 years from now if I start seeing signs that the U.S. government cannot handle their national debt. So far, when I study the national debt, it is not, they should call it the U.S. Treasury debt, because that's all that's taking place is countries around the world are putting their currency in U.S. Treasuries because we're the only country that can tax the people to pay off these treasuries and back them, and it's the only thing that's backing the world reserve currency. And so far, I just don't see a total, complete credit meltdown yet. I do see that they can still pull the triggers and go with negative interest rates before we get into a worser case scenario down the road. So that's
okay.
My answer toward gold and silver.
Okay, that's pretty straightforward. So now, as you go through your what you were going to say, I don't know what you had planned next on this. I kind of interjected in the middle of your thought, but I just know people are thinking that, listening to this, so I wanted to get that out of the way. So,
no, it's well, I think the concerns are very legitimate. Are we at the total end of this country, and just because we're going to have another collapse based upon the banking industry? I don't believe so. They can still. This is the reason why they're testing out negative interest rates around the world, and why there's about $15 trillion parked in banks that will guarantee their principal, but they have to park it and pay the banks. I don't particularly like it, but U.S. Treasuries is a good way to get around all that. And once you pull your money out of the bank, you don't have to worry about paying the bank anything in the future when we have another financial collapse. So when you own cash, that is the only legal recognized money in the world. And U.S. Treasuries are just higher denominations of cash. That's all it is. It's it's seen in $500,000, $10,000 bills, bonds, and notes. So, but it doesn't have any debt obligations attached to it. So, you become the banker when you buy these and own these, and that's the advantage right now. So there is a more speculative way to make money in a crash, but I've already addressed that in our other program called negative interest rates and how those are coming to America. And someone can listen to that program if they wish to take the more speculative route like I am, because I'm convinced that they will have to go toward negative interest rates in order to kickstart the economy again. But that will only be a temporary solution. And keep in mind, when the whole system does come down someday in the future, it also reduces the price of everything. And your gold price prior to our credit system forcing the inflation of everything in price over the decades, gold will eventually have to go back to like $20 an ounce, and silver back to just a $1 silver coin again. So you have to look at it in terms that everything went up in price, stocks, cars, homes, everything, because of this leveraged credit that went into this system over the decades. And now they're trying to figure out how do we deleverage ourselves from it, because if they deleverage, it comes crashing down really fast. So what they've been doing is allowing these mini crashes to occur every 7 to 8, maybe 10 years. And as you can see, they don't know how to handle the situation, because the credit system model was designed never to work indefinitely. It just works for a few decades and then it crashes. You can't keep on loaning out to people that can't pay back. Eventually your balance sheet starts showing the losses and you go under. And that's what happens to these banks. So that's essentially all I can say about what is going on and how people can be proactive about what I'm seeing happen in our economy right now. Is they've got to start acting quicker, and just like the people in Wells Fargo, they see the corruption, they see what's happening to their accounts. They're being proactive and getting their money out. The hedge fund owners in Deutsche Bank, they saw the same thing, the same signs in the Deutsche Bank, so they pulled their money out. And it puts them in a worse case scenario, but hey, it's going to happen anyway. The system is collapsing.
Okay. Now, I do have this PDF that's going along with this. I'm actually running it across the screen. Now, when you convert your money into a treasury, and the other show we did, you did mention this, so I will have all these linked, is you can buy treasuries, bonds or whatnot, or you can get into a fund. Because one of the problems with treasuries, you want to buy a 30-year treasury, it takes 30 years to get your total return. And so it used to be where municipal bonds and all these type of things, long-term retirements and all those type of things were invested in these securities. But due to the length of them in this time frame, it's a little tough to say, well, I'm going to buy a 30-year bond. I mean, you can always sell it and get some money back, but there is a fund put together that allows you to buy into this fund and then pull out of the fund and get your interest for the time that you've been in the fund. And this fund will actually increase in value as well as the securities. And maybe you should talk about how
Yeah.
when the negative interest rates come, the actual bonds will greatly increase in value.
Yeah, this is, I think, probably the best investment idea I've come up ever since I invested in silver back in 2000. I should back up just a little bit. You can buy short-term bills, notes, and bonds as well. You don't have to, from the Treasury and own them on a personal basis without going through some brokerage firms. So using US Treasury Direct. So you don't have to commit yourself to 20 years. You can buy a bond for a couple of months if you wanted. But getting back to your whenever you're investing in, let's say, the 25-year zero coupon bond fund by Bill Gross, I use that as an example. It's a little bit more risky, but if you're convinced, like I am, that negative interest rates are going to be the future, and through all my research and studies, I'm convinced that this collapse will force the biggest negative interest rates on this country that's ever seen. And for every, let's say, point that interest rates go down, the value of your bond goes up about 30%. And that doesn't even cover the maturity dividends, and nor does it cover the price of the fund itself as it goes up. So, it doesn't cover the fact.
Let me go there. So 30%. So you're talking, let's just make easy, $100 bond after the interest rates going down into negative territory would become a $300 bond?
No, it would just be $130.
I'm actually 30%. Okay, so it would become $130.
Right.
And as the interest rates go down in negative farther, it would add on to it. And that's not even including the actual interest of the length of the bond. Correct?
Right.
Okay.
Yeah, this is how you get around these corrupt banks that are going to charge negative interest rates, is you buy US Treasury Securities in the form of, like I say, a 25-year zero coupon bond. And that particular fund has a trading symbol of ZROZ, what I call a ZROZ. And it trades just like a stock. If, let's say, the rhetoric lately has been that the Federal Reserve is going to hike interest rates a quarter of a point, that the price of that stock will go down just through the rhetoric, even though nothing is really done. But when it comes to actually lowering interest rates, it will soar, not just 30%, but almost double in price. Probably, I think it trades right now around 125. And in every recession, the government has to lower interest rates at least 4 to 6% to kickstart the economy. In a depression, one that I see that's coming right around the corner with a possible war attached to it, I see them going negative interest rates almost as much as 10 to 20% over a course of a year. So the price of that fund would just soar into the thousands, and that's why a person, if they have a speculative mind like I do, they can make a lot of money off this particular fund. Now, this is just a speculative hypothesis that I've formulated in my mind, because I know and believe wholeheartedly that interest rates will go negative due to the economic conditions that are deteriorating and a war that's right around the corner. It will force the Federal Reserve to do this. But for the purpose of this program, I just recommend recommending people to pull cash out of their bad banks and hold it physically in their homes and hide it. And anything above that, just simply make a deposit in the US Treasury and own higher denomination bills. And they'll completely clean themselves away from this banking fiasco and corruption that Bill Clinton started in 1999, allowing banks to become gambling institutions. So, and that's the crux of this whole program, is to give advice based on what I see happening right now and what I see coming in the future.
Now, the two ways you can do that would be to either go Treasury Direct or buy savings bonds or what have you. But what do you remember? I'm looking at our list, and we put this on the screen for people. Looking at our past show, there was a PDF that was put together for that show. A lot of information in it. Again, I'll have a PDF to this one. In fact, I'll link to that one as well, because there's some override here. But there was a fund that you had talked about, and if you look at the video from that show, you could see it. I just don't have access to it at the moment. Do you remember the name of that fund where you could go in and out on a securities fund and buy shares, let's say, as opposed to actually owning your own?
Yeah.
You remember what that was?
Yeah, I've already touched on it. It's called the 25-year zero coupon bond fund. Its trading symbol is ZROZ. Then there's another one that goes for 20-year zero coupon bond, which trades under TLT. These are the more speculative. If you believe that interest rates are going to rise in the future, you don't want to get into these. But if you believe that they will be going negative, then you definitely want to make this investment, because you'll make a lot more money than you can imagine. It's one of those. It's one of those things where you're either you know what you're doing, or you're going to look pretty dumb if you're wrong. So, but right now, you can trade in and out of those on a daily basis, and you can trade them just like a stock, and you will collect dividends. I already tested that out. I put around 30,000 in that, and was moving some money out, and all of a sudden I couldn't figure out why I was getting hundreds of dollars in dividends. So there's something else tied to this rather than just the stock price. They also pay a dividend. So I haven't quite figured it all out, completely, because I always thought this was strictly trading according to interest rates and not paying dividends. But apparently it does pay dividends as well. So you can get in and out of those on any. You could go in 1 hour and come out the other hour, or one day and out the other day.
Because it reminds me, I bring this up because after watching the movie The Big Short, which I can't recommend that movie enough to help people understand the housing bubble, and then all you have to do is just take that same model and put it into world currency, and you know where we're sitting. But I'm looking at the PIMCO 25-year zero coupon bond. Currently, it's down half a dollar, and I'm reminded of that movie when he saw the housing bubble, knew it was going to burst. This was kind of a genius guy. He's almost like an idiot savant type of a thing. He saw it was going to break, and he put that fund in there, and it was losing money. And it was losing money, and they're going like, well, wait a minute, we got to pull out. He goes, no, this is going to make a fortune. And so right now, because the dollar is growing, it is gaining basically over the other ones. There's a slight dip, but when we did the show, we looked it up, and it was up huge, like 14%, a huge amount up. And that's because at that time things were going down. So this is one of these things that you buy into and you're basically selling the Federal Reserve dollar short. I mean, it's probably not that it's accurate in a crude sense.
Well, you're really selling the whole economy short, not so much the dollar. It can soar with the dollar. It's not looking for it strictly trades on interest rates and not on the currency itself. It bets directly on whether or not interest rates are going to be forced down in the future.
So interest rates go negative. This thing just soars off the charts. And they were talking about raising interest, and this is why you brought up about the war, rumors of wars, and all this stuff to try and keep the Fed from raising the rates. I'm guessing, I mean, not an expert, but I'm guessing they have no intentions of raising them. They know they should raise them, but they can't raise them because the reason why things haven't, collapsed worse is because the money is so easy to get to move this debt around.
Yeah, there's the Federal Reserve is in a very sticky situation. They know that they can't raise interest rates. They know that the last time they did in December of last year, the stock market crashed 3,000 points. The only way they could get the stock market to go back up is to not raise interest rates ever since. So the only thing that really is going to save them in December, when the Fed meets in December 13th and 14th, is I think there's going to be some kind of downturn in the stock market that's going to justify them not even doing a quarter point raise in the stock market. And I think that will start the ball rolling into the negative interest rates. Once you get a stock market reeling down for whatever reason, it could be the war diversion that I'm seeing brewing. It could be another banking blow up. It's just the economy is not getting better. It's slowly deteriorating, and everybody knows it. And so it's highly unlikely even that they're going to do another a quarter point interest rate hike. It's just not going to happen, and if they did, it would crash the market because the banks can't pay any money out anymore. They have to constantly get infused money, and they've used up people's deposits. They've used up their taxpayer money, and the only thing left is to go negative interest rates. That's why I'm very confident that these funds will soar in the next crash of the stock market, not the dollar. The dollar will actually get stronger, and this will force oil prices down, gold and silver down. Other countries will crash. They will buy US Treasuries before they'll buy anything else. And even when China was recently accepted into the IMF, their currency included into the special drawing rights on October 1st. Ever since they were accepted in with the world reserve currencies, their currency has been crashing against the dollar almost every single day. So their whole idea of trying to replace the dollar is a joke and a fantasy, which is another indicator to me that you're going to have a dollar that is going to soar against the euro here very shortly, and you're going to have another commodity crash along with a stock market crash, and this will instigate and force the Fed to lower interest rates. This is my speculative hypothesis. So just keep in mind, I'm speaking based on what I think is happening. But when I'm talking about U.S. Treasuries, that is a fact. Whenever you take your debt-based earnings off your job and invest it in U.S. Treasury Securities, you become the bank, and the U.S. government becomes the loanee. And they are guaranteed to pay you your principal and everything else back. So I hope this program has enlightened people in understanding what what kind of laws have been passed behind their backs, and what the future holds if they don't do anything about their money right now. Again, pull your money out in cash. Anything left over, you can't pull out. Try and get it into short-term US Treasury Securities. And if you have a speculative mind, you can try this latter idea that we just mentioned, the 25-year PIMCO zero coupon bond fund, known as trading symbol ZROZ. That is the speculative part of my recommendations, but I don't say that is for everybody. That's just for people that have extra money that they don't know what to do with.
Because when you talk about pulling out money out of the bank, I'm going to say, well, I got $50,000 in the bank, I'll just pull it all out. Well, you're going for a rude awakening when you pull up to that bank and say, I'd like to have my $50,000 bills in $100 bills, please. You're going to get sorry, ain't going to happen.
Right. So they can do a wire transfer to U.S. Treasury Direct and buy short-term U.S. Treasury securities. The banks cannot say no to that because it's just another way of transferring your debt obligation earnings into IOUs that the government will eventually have to pay you back. But you leave it in that bank right now, I guarantee you they are broke, and they are trying to figure out and make desperate decisions on what to do, how to get more money into their banks. They really don't know what to do now. Wells Fargo is a very good example. They got caught, and they got caught cheating people. And it was almost like 2 million customers that they cheated. I mean, opening credit cards under their name and other accounts under their name without their consent, and charging them on products that they never ordered. So, Wells Fargo is experiencing a bank run, an old-fashioned bank run that I think will bury them here very shortly. And who knows what other banks will follow. So it's up to the person now to do something. They can get proactive and start protecting what they've been earning all their life. This program is probably the most informative program I've ever done in the financial world. And again, I want to give you all the praise and thank you for allowing me to talk on this program, because I have to do this on an individual basis sometimes, and this is just a quicker way to get that information out abroad, and the internet is a great avenue to do it with.
Yeah. Okay. Well, I know you got to go, and I do want to. I'm going to continue and summarize a little bit because I know when we talk about things that are askew off the normal path, it's like when you're making this weird left turn, you're in areas that you're not used to doing. The idea of the standard safety procedures are normal in your mind. And so I just wanted to thank you for doing this. I mean, again, you're just coming out and sharing information, but people can use this. And this is something, I'll go into this as reiterating in my closing remarks about what people can do. But I want to thank you for spending the time to let us know. I would never have known this, without you saying anything, and I'm sure a lot of people are thinking this as well. The key is to get you through what's coming, and some of the traditional members of gold, silver, and all that, they're going to suffer as well, because this is beyond just the standard rep, and this is not inflation. This is something a whole magnitudes worse. But again, I appreciate your time. Thank you very much.
Oh, you bet. Yeah. If I just should mention one other thing.
Okay.
This whole thing that we're experiencing in our economy is a worldwide deflationary depression that they're trying to slow down as much as they can by taking as much money out of the economy through the form of higher taxation, bail-ins. The next idea will be negative interest rates. That is, I think, the last straw. And then I'll sit back and take a look at things and decide whether or not, after gold and silver crashes, if I see that as a time to buy it, then we'll do another program, and I'll make that recommendation or not. But right now, negative interest rates is the order on the plate, and that's my prediction. So I just wanted to leave you with that on the program.
All right. Sounds good. Well, it doesn't sound good, but you know what I mean. Thanks for the information, and we'll keep in touch on that.
Okay.
All right.
Thanks again.
All right. Yeah, I had to let him go, but I want to do a quick recap. See, the idea here is to keep the value of your money in terms of the vehicle that it's in to be used to purchase goods and services, because the money is only a vehicle of value. And so with the traditional methods of doing things, they're all out the door. First off, the Dodd-Frank basically takes your savings and makes it the bank's property. And they're an unsecured creditor, like a credit card. If you have a big credit card and you go bankrupt, they can't come take your house for the credit card. It's an unsecured loan. That's why the interest rates are high. It's a higher risk for them because they have nothing to come back on it. So the banks become you're an unsecured creditor to the banks. The banks collapse. They go, sorry, you can have a piece of we sell the building, well, maybe you'll get a nickel or something, type of thing. So that's gone. There's nothing, no insurance. There's no backup. Also, in the past, they've changed the laws on how they can invest. So now rather than allowing you, being very conservative, they're actually going into the casino of the stock market and winning some, but losing lots of money as well. So then you have the way that they compound, they calculate the value of their banks, about their assets. Before, you used to have a formula you had to use to come up with your true asset value to show if you're above or below water. Well, now the law was changed that in there to allow them to use whatever means they can and whatever values they can to come up with their value. So they could turn around and say, these glasses, by our value, are worth $10 million. So therefore, with all of our debits, we're in good shape. So that's another aspect that's changed in recent times. So now you have the idea of interest rates going negative for your money in the bank. So now you'll be paying them to keep your money because your digital money doesn't exist. It has to be kept in some medium somewhere. And the banks are negative. So now they got to come up with more money. They had bailouts, bail-ins. They can't go into they can't do another $20 trillion in bailouts. So they're coming up with other ways. And one of these ways, we were talking about some of the ways. Now there's another one of lowering interest rates into negative territory so that you will be charged to have your money in a bank. It's already happened in several places in the world. And so what Lionel is saying is also traditionally people get gold and silver. Right now gold is $1,200 and something dollars, as of $1,270 I think it was. I looked earlier as of this show, October the 30th, 2016. At one point it was $35. Well, with the inflation of the dollar, the gold retaining its relative value to the dollar, it's now $1,200. But now we've come to a point where the inflation is not. Inflation is there's more money being put in quantitative easing, but the money is not in paper dollars, so it never hits the streets. So there isn't the traditional inflation, hyperinflation that has been predicted because they're not actually printing dollars out in the street. that money's going up into the banks and up into shoring the bank lines. That quantitative easing doesn't actually, because inflation comes up when everyone gets $1,000 a week raise, everyone raises the prices because everyone's got more money. They can start to ease up the prices. That's traditional inflation if they just start printing money. But they're not printing money. They're not printing money. They're making digital numbers get bigger, which it's bad as well, but it's not the kind you would used to. So what you have now is the banks, when they take a holiday, your digital money in the bank is not accessible. So how do you buy things? Well, use your credit card. Oh, I'm sorry, that's turned off as well. Well, how do you buy things? That's why Lionel talks about having cash, because the dollar bill, for all its fact that it's arbitrary value, it's a piece of paper, but that is what we use to buy things now. And so what will happen is those dollars are in short supply. The physical money is in short supply. They don't want you to take it out of the bank. They'll write you a check to go into another bank. You go write a check to go into the Treasuries, but they won't give you dollar bills. They're rare. And so what happens in the short-term collapse, you have dollar bills. You go out and you buy a gallon of milk, a loaf of bread. And because people don't have the dollars, the prices start to go down because they'd rather take your dollar. You say you want to buy $100 worth of stuff. They'd rather take $70 than nothing. And that, of course, there'll be rioting and looting at that point. And this is where you get into that whole problem. Now, by having the gold and silver, as everything's collapsed, so will gold and silver. It'll go back down. It doesn't mean it'll be worthless. It means that when you have gold and silver and you're in this short-term collapse and you go to the gold and silver guy to sell him back gold into dollar bills because Walmart won't take $25 gold pieces, or they'll give you $25 for them. You go back to the gold and silver guy and you want to sell to him, and he's like, I'm sorry, I'm keeping I need the money. So now the price of the gold and silver goes down because you kind of convert it. Now, there are places around the world, and there are places in the United States where barter is more common. In the big cities, it's not. So there is a way that you could still have people accepting and agreeing to exchange in gold. But the price will go down because of the lack of liquidity of the dollar in the way that people go about buying things, which is in cash or in credit, when credit is now turned off. So what Lionel is saying is take as much cash as you can and keep it, because first off, the interests in the banks at this time are very little. So you're not losing much by sitting on the cash. And then when this events take place, you'll have this cash. You'll end up making a ton of money on it because the value of the dollar will increase. Prices will decrease based on the supply and demand of the vehicle to buy the item. Again, you won't have the digital money. You only will have cash. So Lionel is saying cash first. Get as much cash as you can, but the banks don't like giving you cash, plus the IRS gets a little wiggly. All of a sudden, they look and say, oh, this guy's pulled out $50,000 in cash over last year. What, is he drug running? Is he stolen merchandise dealing on it? Because, cash is historically in this country is looked upon as doing things nefarious. So now you bring attention to yourself. So there's that line you walk. So what Lionel is saying, that you take the rest of your money, say you can only take a few thousand out or whatever, the rest of the money, if you want to get it out of the bank before it collapses, is transfer it over into Treasuries, Treasury Securities. And there's two ways you can do that. You can go Treasury Direct, buy these various securities, short or long-term bonds, or you can go into the zero coupon bond funds they were talking about, so that you could speculate on the interest rates for making money. In other words, selling short the interest rates. Interest rates go down, your profits go up big time. Just like in the movie The Big Short, dealing with the falling of the real estate prices falling. Therefore, they when you sell it short, you make money on the fall. This is the same kind of idea here. And for people who do have gold and silver, if you bought it low, you won't lose as much. And it doesn't mean that gold and silver won't have value in the long run. It means that it won't retain its current value. And the only way it can is by hyperinflation, which we're talking about not happening because there isn't a lot of money flowing around on the streets, where this inflation comes from. So I hope I've did it, because it's counterintuitive thinking we're talking about here, and it's hard to do that. When you have to stop and rethink and re-explain and redo it, because you're rebuilding a path road of thinking. You're laying down these planks and oh wait, but that's right, that doesn't go there. I'm thinking the other way. It's got to go this way, and it's rough. And once you make that path out and you go back and forth and you keep on hearing it over and over again, you understand it better. You can start to build your mind around the way things work in it. And when you do that, it becomes better understood. And it took a while with me talking to Lional. I had the benefit of having him on the phone several times when I was driving. And so I get it. I get what he's saying. And that it's, of course, the federal, the government, the Treasury isn't non-vulnerable itself, but then, at some point nothing is. And that's where, if it gets bad enough, yeah, gold and silver will be worth something, but it's how much of it's worth at the time. King Midas comes into mind. He wanted everything he touched turn to gold, but then he couldn't eat because everything he touched food he couldn't eat. And the idea there, I think, is that you can have all kinds of gold, but the people aren't willing to trade it for food because they need food, and you can't eat gold. When you get down that far into things, everything goes crazy. So anyway, that is what I'm saying on this, and we'll leave it at that for this show. Remember to look down and get this information. I'll put the other one up too, these PDFs with Lionel stuff so you can do research on it and read. And there we go.